He's Nolan Watson, President and CEO of Sandstorm Gold, the world's fourth largest royalty company based on market cap. Nolan, welcome to Kitco.
Well, thanks for having me.
Look, we've talked lots of times in the past decade where gold seemed to be moving sideways. We've certainly turned things around. I guess it's years or times like this that kind of make the industry exciting, to say the least, Nolan.
Yeah, these are definitely interesting times, and it feels interesting because the world doesn't feel very good right now, and COVID and all those types of things, but it sure feels good to be in the gold business.
Let's step back and talk about basics. What is driving gold right now?
Well, I think the normal narrative, it's money printing. The Federal Reserve is printing hundreds of billions of dollars of new money. They've expanded their balance sheet dramatically over the last 3-4 months, and they're continuing to do it. And it looks like there's no end in sight. And for the first time in a lot of years, I think everyone can look at government balance sheets and say governments are now functionally insolvent. They need to issue debt to continue to operate, and there's no one out there to buy that debt other than their own central banks. I mean, I'm sitting here in Canada right now, and for the first time, our central bank is having to step in and buy our federal government's debt because there's nobody else out there to buy it. And so when they do that, that just puts enormous amounts of new cash into the economy, and it inflates asset values. And so you're starting to see huge inflation in gold prices, but you're going to see it in other asset classes too. And when the Fed starts pushing, everything starts going up.
We saw this playback back in 2008, where a lot of the same themes. Is there anything different this time around in how it's playing with this uptick in gold prices?
Absolutely, yeah. Last time, say during the Great Recession, the Fed started pushing, and we saw this phase where asset prices started lifting, and gold was one of those first asset classes to lift. But the government's balance sheets and the corporate balance sheets were still strong enough that the central bankers could, over a period of a few years, start pulling back and start increasing interest rates and reduce their quantitative easing, and then eventually eliminate it altogether. And it only took a few years. So the Great Recession of 2008, gold kind of peaked in 2012, and then it started falling off, and most gold companies lost substantial amounts of their value and their market caps in 2013 through 2015. This time it's different in the sense that the amount of debt that the governments have and the size of their deficits is so astronomical. It's a completely different period. That the governments will not be functionally solvent. I mean, the US is running a $3.5 trillion deficit, and Canada's about 1/10 that size. Our government just came out and said they're going to run a $343 billion deficit this year, which is a 40% increase in our national debt in 1 year, which is just amazing. And there's no way that the US has any chance of being solvent unless they inflate away their debt. And so they're going to keep doing it. This central bank easing is going to be, it already is record numbers, but it's just going to continue, and it's going to continue a lot longer than it did last time.
Is there wider investor interest in precious metals?
Yeah, I think we're starting to see it everywhere. We started to see it at the beginning of COVID when larger companies could do, in the precious metal space, large equity placements for the first time. The equity window did open up for the first time in years, and then it moved down to the mid caps. And I would say just in the last 4 weeks, it's absolutely moved down into the junior space too. So we're seeing junior exploration companies that haven't even found a mine yet go out and try to do what previously they would have tried to do $1 million financing and failed. And now they're emboldened, they're trying a $4 million financing, and they're getting books of $10 to $20 million. It's pretty astounding. The whole world is rushing to gold right now.
Let's play this forward. You're saying that we do have debt loads that are going to be unsustainable. What do you see over the long term?
Well, if over the long term you mean 10 or 20 years, I think the central bankers are going to have to literally just sort of reset the prices of everything in our economy. And so they're going to have to continue the quantitative ease. They're going to have to continue that money printing process, and they're going to have to make dollars worth less. And that's going to take years and years and years. Eventually it will turn into inflation. Definitely not now. Right now we're sort of in a temporary deflationary environment while COVID is happening. But eventually that'll turn into some inflation. And that inflation, I think, is going to continue for a number of years until the government has effectively monetized their own debt, and it's a reasonable balance sheet again. I think that process is going to take 10 years. And so this is a total game-changing thing that's just happened here.
Let's talk about Sandstorm. You had your Q2, and then obviously things are disrupted right now. Can you talk about where you are with production and where you see going forward with Sandstorm?
Yeah, when COVID first hit, so we withdrew our guidance because obviously we knew some mines were shutting down around the world. We didn't know which ones were going to happen as they relate to us. And during Q2, we had about 50% of our mines go down. A number of them came back on pretty quickly. So we had put out our Q2 guidance or our Q2 results just recently. And Q2, we were only down about 25% on the quarter compared to what we would have previously budgeted, which is pretty good considering all those mines that had shut down. So we're sitting here today, all of our mines have started back up, which is fantastic. It's important to note in the royalty space, often you get paid this month for the production last month. So they have to produce, figure out what they produced, and then send that cash check to us the month after. So July might be a little bit weak because it's actually referencing what happened in June when some of our mines were still down. But I think by August, we're going to be into record monthly cash flows, and we're going to be drinking from a fire hose of cash. We're definitely going to be having record quarterly cash flows as long as the mines stay up and running.
Can you tell us about Hod Madden and give us an update?
Yeah, Hod Madden's moving forward. I got an update of that actually this morning from our technical team. There's a substantial amount of activity going on behind the scenes. Feasibility study is in the works and still expecting to have that feasibility study out by the end of this year, and probably by the end of this year, some of the early earthworks too for things like roads and potentially tailings dams and those types of things. So the project's moving full steam ahead.
I like stepping back and then talking about the markets altogether. I always enjoy having you on, Nolan, because of your insights, just talking about the retail investor versus the passive aggressor, the passive investor. Can you talk about how those trends carried forward? I know that you do have the relationship with Equinox, and they've built a company that has, how would you say, it's been built for the current investor environment or the current investor landscape.
So one of the things that I talked about in the past is the amount of money that over the years has been moving from actively managed investors and actively managed funds to passive funds. That process has continued. The amount of money money is still moving from active to passive funds. And one of the problems with that for our industry typically is that the passive investors cannot participate in equity financings, which means in normal times, we're definitely not in normal times now because of COVID, but in normal times, mining companies are no longer able to raise their equity, and that really is a problem. And in order to attract those investment dollars in normal times, you have to have size and scale and have a company that is eligible for those investment dollars from those passive funds. And so Equinox is a great example of that. They've gotten fairly big fairly quickly, and they've had a huge amount of investment from those passive funds that used to own 0% of Equinox and now own, I don't know the exact number, but I'm guessing between close to 20% of the company, which is a real material difference. And so Sandstorm's the same. We've probably got about 20% of our investor base and growing now, just totally passive funds. They won't talk to you, they won't call you, you can't call them. It's just totally passive money. And so it's an important part of building a company is being eligible for that capital. Now, having said that, this is definitely not normal times. And right now the whole world is looking to gold. And so all of the active money that's out there, a portion of that is looking to invest in gold. So there is an equity window that's available to mining companies right now. And a lot of mining companies are actually taking down that equity. Curious to see how long this lasts.
Nolan Watson, thank you very much for speaking with Kitco.
Thank you.